is mostly gonna be about just question and answers. And probably maybe at the end we'll probably look at maybe one or two assets. Just gonna quickly just sort out a few things with this. I'm gonna disable the waiting room so people can actually enter more freely. Give me 2 seconds. Let me do that. Um, right. Okay, that's done. So I muted everybody, because I don't want to kind of a clash in terms of when people talk, so we don't clash with each other. We can have a more organized way to communicate today. So today is gonna be about question and answers, and because I've noticed a lot of people, ask similar questions, and this session, my aim is to make sure that I answer all the questions that you guys have, so we can actually have a discussion about it one on one, and then give a more clearer headway on things that we need to, or where we need to be at. You understand what I'm saying? So if you have a question that you want to really ask, that's on your mind, or something you don't understand about the market, don't feel like, don't feel like, don't feel shy. You understand? There's no question. There's no silly questions. There's no question that doesn't deserve an answer. So I would say, if you want to ask a question, though, there should be two ways to do it. Is either you type it up, or you raise the hands up in the chart. That way I can then unmute you, so that way we don't have a clash. Okay. So if you have a question, we can get started. You can type it up in the chat room, and then I can start answering those questions. Or you can raise up your hand, so I can unmute you, so we can then get to discuss about this. Mm. On that note, one thing I notice a lot is a lot of people ask me about what ATR is, and ATR is something that I presume a lot of people don't understand how it works, or what it's really meant to do. ATR is more like, we call it the average true range. So with ATR, what happens is it looks at the candle in a specific period of time. So let's say on the daily time frame, if we had the ATR loaded, let me show you how to load it on MT4. You go to indicators, and right there after indicators, you see right there average true range. And what this means, period means 14, which is the default, means the last 14 candles. So if you see my screen right now, this candle is candle one, candle two, candle three, four, five, six, 7, 8, 9, 10, 11, 12, 13, 14. And what it will do is it's going to check the last 14 candles, check how many pips the body of the candles are, and then add all of that together, then divide it by 14 to give us a value. Now, on your screen, you might have the ATR style, which is the color on a specific color, but I don't need the colors because we're not really looking into the color. We're mainly looking into the number that it gives. So as you can see right here, it says ATR and it says 14, right? And then right here, it says 68. So that means there's 68 pips on average in which this candle has done in the past 14 days on the daily time frame. If we change that time frame to 4 hours, for example, we can see that now it's changed to 41. And now, because it's going to look at the past 14 candles on the 4 hour time frame, which is 1, 2, 3, 4, 5, 6 till 14. You get the gist, right? So basically, what this does is to help us, is to assist us to figure out where our stop loss is most likely going to be. Now, let me give you a prime example, right? If we say, let me look into here. Let's say we took this trade around this. Let me see. This is not really a good example. This is kind of trendy. I'm kind of looking for something slightly choppy to describe it a little bit more. Okay, let's say we took the trade for a sell around here, for example. We took a sell around here, and we're aiming for the 200 moving average, EMA, right here, right? So what happens is, if we use a normal stop loss, let's say we enter the trade somewhere around here. Let's say this candle right here. Let me just mark that out. Um, just mark that out with an arrow. Let's say at this candle right here, we took a sell, right? We took a sell entry right here, and the price went 26 pips in our favor, but we didn't lock it in. we didn't lock it into profit zone. And if you don't understand what locking the trade means or moving your stop loss into the profit zone, just you can raise your hands up or just type it in the question in the chat box saying I don't understand what that is, and I'll explain that also. So basically, what we do is we take a, let's say we took a sell entry at this point, and then on a normal base we have our stop loss around here, right? 27 pips from our entry zone, right? And then let's say our aim is to get here to the 200 moving average. Anywhere the price touches 200 moving average, that's our aim, right? And price tends to go down. And what price then do was started coming back up. Our on a normal situation where our stop loss would have been behind this line right here. So if I went in here because of the consolidations right there, I would have ideally put my stop loss here, just slightly above this week, right? So if I had done that, what would have happened is over time, price came in my favor, went back out, came back in my favor, and eventually rated me out. And then went a little bit higher and then start going back down. With the ATR, I
Wait, I can't hear you.
I can't hear you, sir.
I can't hear you. You are off.
my
Hello.
yeah, can you hear me now?
Yeah, but
Hey, hi.
Hey, Shane,
Hi.
good.
How are you?
I'm good. I'm good. How you doing?
your mic
Fine.
is kind of low.
I'm far from it. Can you hear me better now?
Yeah, it's better.
Hello. Hello, your voice is not clear.
What about now? Is it better now?
Yeah, okay.
Yeah, I can hear you.
Okay, beautiful. Okay, is it good now, guys?
Yeah, it's okay.
Yep.
Okay, beautiful. My sound card switched. It switched away from the sound card and switched to the computer sound. That's why that happened. Apologies for that. So I'm just gonna take that again. I'm gonna re-explain that again. Someone's popped something in the chat. Okay, yeah, I would explain what locking is in a second. So let me finish with this ATR, then I explain that. If you have more questions, just put it in the chat box and I'll answer those questions. So basically what happens is, let's say we had that entry right here. Now, based on the ATR value around this time period, what it would have done is it would have added the previous 14 candle and seek for the average, and that average value would automatically become our stop loss. So let's say in this scenario, for example, we could have had a stop loss for my ATR to be 50 pips, for example. You understand? So what I normally do is I times that by 1.5. So if we have that 50 pips and we times it by 1.5, that will give us a 75 pip SL value based on the 4-hour time frame of ATR. So what happens is, let's say, for example, you went into this trade and it went all the way down, pulled back up, then went back down. And because of the ideal way we trade and we entered around this zone, our stop loss would have been here. What would have happened is we would have got rated out. We were not wrong. Your analysis was not wrong, but we were just rated before the time. Some people will say, oh, the entry is wrong. The truth is the entry is also not wrong. It's just the stop loss that was wrong. So you get stop hunted, which is also called rating. They raid you out of the market, kick you out, and then eventually price start going down, pulls back up again, and then eventually hits your take profit. So you would have feel very pissed off right now because the market did all of this nonsense move just to get to this point. It would have been more straightforward. The price just go to that point. But where most people lose the money in trading is in the consolidation, is in the raiding. They try to raid you as much as possible. Okay. So what the ATR does is to help us eliminate the raid so we don't get raided. So if, for example, the stop loss the ATR gave us was 50 pips, for example, let's say around here, if we times that by 1.5, we give ourselves an extra couple of stretch somewhere around here so we do not get raided by the market. Okay, that's practically what ATR does. It gives us a very wider stretch based on the current move of price, so we don't get rated out of the market by the elite traders. Okay, so one thing we have to keep in mind is ATR helps us figure out where our ideal stop loss is going to be. And the funny thing about the ATR is the smaller the time frame, the smaller your ATR value becomes. So if you go to 30 minutes, for example, your ATR value becomes 18 pips. But what happens is the smaller your time frame, the smaller your ATR value, the tighter and the more smooth your entry has to be. Your entry has to be more precise. So for guys that are very new, that the entry is not perfectly spot on, you understand? The best thing is to stick with a higher value ATR time frame, so it gives you enough room, even if the trade pulls back, so you make more money, so you don't get rated all the time. You understand? In this game, you're always gonna take a loss, and you're gonna always have a win. Okay, that's that on ATR. Does anyone have any questions related to ATR? Please, if you have any questions related to it, feel free to ask. Today is just an ask session. It's all open for asking any questions that you want to ask. So feel free to ask if you have any questions. Someone has their hand raised up. Okay. Yeah, you can unmute yourself.
Yeah, thanks. Thanks for the privilege to ask and get more knowledge about ATL. So my question is this. Now, like you said, for beginners like myself, you're starting out with Forex, and I want to ask for me to prevent being rated out. What is the ideal sign, the best sign, like the perfect time frame to use for entry? You know.
All right.
So that's the question.
Okay. The ideal time frame for entry, so not to get rated out the most, will be the higher your time frame, the better it becomes. So let me say, for example, on the monthly chart, this is a monthly chart. This is how I like to do analysis in most cases. I like to go from the top time frame down to the bottom. If you're looking at the monthly chart right now, so I'm just going to delete. I'm going to delete this stuff. By the way, I haven't forgotten the person I mentioned about the I think it was the entry stuff. Not entry. Wait. Locking the trade. I'll get back to that in a second. So if we look at the monthly chart right now, you can see price tend to move up. It looks like an uptrend, a buy bias, right? If we
Mm-hmm.
switch to the weekly chart,
Mm-hmm.
we can see that it's still an uptrend, but there's a pullback. Switch to a daily chart, you're seeing a downtrend happening. Switch to the 4 hours, and what we're looking at is now a downtrend. So if you're looking at the monthly chart, you're seeing an uptrend, and you're looking at the 4 hours, you're seeing a downtrend. You have to understand something. The bigger the time frame, the more accurate your analysis is going to become, right? So,
Mm-hmm.
for example, you're familiar with Wix, right? If I
Mm-hmm.
was here at this particular date right here, 1st of March, 2020, this day would have looked like a downtrend on a lower time frame. It wouldn't have let me spot the uptrend that is coming. You understand? So what happens
Mm-hmm.
is I might have taken a sell entry somewhere around here, and then price ended up pulling all the way back, rating me out instead of going back up.
Wow.
You understand?
Mm-hmm.
So what the bigger time frame does is it gives you a bigger picture. It gives you the full picture of the game. So you see a full picture, and then you deal from that full picture. You make your analysis from top down. So you don't make your analysis from a smaller time frame to a bigger time frame. You make your analysis from the biggest time frame to the smallest time frame. And I don't literally want to say you should go anything below 4 hours for your analysis. So you start from the monthly, for example. From the monthly, when we're looking at this, what we can see is the 50 EMA right here, literally is kicking it back. So price seems like it wanted to break the 50, but it couldn't break the 50. So now it's bang on the 50, right? So I know
Mm-hmm.
now that most likely price might not cross over this 50. I mean, the month is already ended. So price is not crossing over this 50. A new candle is going to open. It's either open slightly above or slightly below the 50, right? And then I come
Mm-hmm.
to the 4 hour time frame. I see my 200 moving average lining up. So what I can expect in most cases is probably price is gonna could open at the same part and the same spot or slightly lower. And then if it opens lower, it's gonna most likely test this 50 moving average to kick back up. And what that's telling me is that from the bigger time frame, it's supporting more of a sell move, depending on where the candle is gonna open up on the monthly, right? So if the candle
Mm-hmm.
open up above it, the 50 EMA is going to be a support. And if the candle opens
Mm.
below it, the 50 EMA is going to be a resistance.
Resistance.
So what would
Mm-hmm.
happen is if I look at what's it called, on a weekly time frame, if that same thing falls below the 200, I know now that I have my 50 EMA on a monthly giving me a resistance. the weekly 200 EMA giving me a resistance. But what I'm not seeing on the what I've actually, wait, hold on, let me mark this part out right here. What I'm seeing on the what's it called, on the weekly time frame is there's a 20 and a 50 right here around this period. And what I'm seeing also on the monthly is there's a 20 EMA around that point. So price is most likely going to get trapped between the 50 EMA and the 20 EMA this month coming. And my weekly also confirms that. If price tends to open below here, it will be trapped between the 220 and the 50. So what would happen is if I look at my 1 hour time frame, this time frame doesn't matter anymore. All I'm doing here on 1 hour or 4 hours right now is just looking for where will be the ideal entry. And if price gets to this point, this red line right here, that would be my entry on the 4 hour time frame. Look at where the entry would be. So I don't even need to look at the chart and deal with the smaller time frame, because the bigger time frame has already given me most likely where price is most likely going to hit. If I look at my weekly, I see it's most likely going to hit the 50. And if I look at my monthly, it's most likely going to hit the 20. So I can ignore the 200 moving average right here, because price most likely is going to break it and come all the way down to here. And from the PZ, I already see a support. So the issue here with most traders is most people would not be patient enough to wait to this region. And most people thinking because it's going to get there, I would rather take a sell now and sell. You understand? So it creates impatience. I don't know if I'm banging on a point right here for you to understand.
Yeah, you are.
So it creates impatience from people. Sometimes when you've done your analysis from the bigger time frame, it's best to just stick to what the bigger time frame tells you than to go on a smaller time frame like the 15-minute or the 5 minutes or the 1 minute. If I'm looking at this on a 15-minute, this thing look at as if it's been going downtrend forever. It's been trending down forever. But when I look at it on a monthly, it's not even started the downtrend yet. And it's showing me that this is most likely going to be trapped. So if we look at it, the most accurate part is the monthly chart, followed by the weekly chart, followed by the daily. And then the 4 hours should be ideally for entry. The 1 hour, 30 minutes, 15 minutes, 5 minutes, 1 minute, these are all nonsense. Look at the 1 minute. 1 minute just looks stupid. You understand? So why would I want to trade with this? On the 1 minute, it looks like this has been going down for a very long time. Let me take this thing off right here. It looks like it's been going down for a very long time. Look, this is 1 minute. It's been going down from here. And if I'm even not mistaken, it's more even longer than that. So what I would bang on to you today would be mainly focus more on your higher time frames and 4 hours for entry, because the support region for 4 hours is more stronger than the support region for 5 minutes, 1 minute, 15 minutes, 30 minutes. Okay. So whatever my 4 hour supports, like the 200 moving average right here, or the support line, is going to hold more ground than whatever my 15 minutes gives me as a support or resistance. This could be broken easily. You understand? Okay, beautiful.
Thank you so much.
Not a problem. Does anyone have any questions regarding that before I move to the next one? Okay, no. Okay, let's move to the locking the trade and profit. So what does locking a trade mean? So now let's give an example. Let's say we went in on a trade on a 4 hour time frame. I always say this a lot, and also I need to explain what on wick means, so for you guys to understand a little bit more better. So let's say this entry. Now I went into the price around here. So I went in when price crossed over this part, and I started selling, right? What would happen is, let me say I sold right here, right? Let me say I sold at this point. Now, when price start moving down, when I say lock your position in profit, it means that your SL value, let's say this was that SL value. Let me just create another line right here. Let's say this was my SL value right here, right? And my take profit is right here on the 200 moving average right here. So once price has gone down already to this point, and I say lock yourself in profit, I expect you to move your SL line into a profit region. You know what I'm saying? move your SL to a profit region. So that way, if price ever pulls back, it's not going to take you your money away from you. It's going to give you some little amount of profit. You understand? So rather than the price pulling back and then raiding your initial stop loss that might have been here, for example, why would I want to take a loss? Let's say I could take a loss of 200 pounds right here. I wouldn't want to take that loss when I know that I can take a profit of 50 pounds right here. So the main reason when I say lock yourself in profit, it means move your stop loss from behind the sell to in front of it. You know what I'm saying? So move it down a little bit. So if your stop loss was here, move it all the way down here. Obviously, use your ATR value. So if let's say, for example, my stop loss was right here, and at this point when this new candle opened, I said, you know what, lock yourself in profit. What I'll do is I'll divide my ATR by 2, which is now 41 divided by 2. That should give me about 20.5, if I'm not mistaken, 20.5. And I'll move my stop loss to about 20.5 in. So 19. Oh, let's see right here. So let's say around here, I'll move my stop loss around here. Now, what price did was price almost came close, but it is okay to get rated sometimes. Sometimes it's cool. You can get rated sometimes. So far, you're rated in profit rather than it raiding you out in loss. So you can take that small profit if it raids you and then find a way to re-enter the trade again. Okay, so that's what literally locking yourself in profit means. Does anyone have any more questions about that? Okay, so someone is talking about confirmation to enter the trade. Okay, so trading confirmation for me would be EMA bounce off in most cases. So let me give a practical example. Let's say we were right here on this day right now. Price seemed to have broken away from this zone. If price comes back now and retest this zone right here and this 20 EMA, and I'm seeing prices not closing below the EMA, and price tend to now break above this point right here. That's my buy entry. So what I'll do is once price breaks above, let me try to zoom in a little bit so you can see what I'm talking about. So let's say I want to go into the trade and I want trade to hit the 20 EMA as my confirmation. So if price breaks out of this region right here, breaks out, what you should do is whenever price breaks out, right? This is the funny thing about price. Whenever it breaks out of a region, most cases it comes back to retest that area. So what's going to happen is this, right? Price broke out of this zone. I wouldn't buy the breakout. I would buy the retest. Now, looking at the 20 EMA, I'm looking like, look, price is most likely going to retest the 20 EMA for support region. And from what I know already, this region right here, this entire region that price was consolidating is most likely my entry region when price breaks out. When price broke out of this zone, is most likely going to retest somewhere around here. And now the 50 EMA seems to be the only one in that region for me, right? But look at this. 20 EMA is also above. So that also acts as the dynamic support. Price came back and retested, rejected. Stopped on it, rejected. Came back, retest, rejected. Now it's giving me so much zone. It's giving me now this new zone right here as a zone to look at to buy once price breaks out. So once price breaks out of this zone, I should be looking to buy when price retests this zone, and I will move it. See, as I'm testing here before, I'm going to move my entry again to right somewhere around here. You understand? So whenever price comes back and retests somewhere around this region, I will go in. So price broke away from that zone and came back and tested the tip of this candle right here. It didn't test this tip. It went beyond this tip. It tested this tip right here of this candle right here. If I'd gone in on this tip right here, I'll get a spot on entry. Sometimes, let's say you miss that tip, it's probably going to do a second entry for you if you're very careful. Look what happened on the next candle. Came back all the way down and see where this tip is. It's somewhere around this tip as well. Gave you a second entry around this tip. So this tip right here is also the same around this tip right here. That's your second entry. If you miss that entry and you say, oh no, price is running away, always keep in mind, price always give you entry again. This market is so stupid like that. It gives you entry again just to make sure that you get on that both. So it goes up. Guess what? The new entry zone is now here. So it's filled out this part. The new entry zone is now totally here. Guess what happened? Price came all the way. Let me get the tip of this candle right here. So price came all the way here. And guess what? It bounced on the 20 EMA. It was literally how many pips away? it was 2 pips away before it tests the tip of this candle and price tend to live. So if you're not patient enough, you can just get it on the 20 EMA. Since you've seen the 20 EMA holding his ground right here, held his ground right here. You know when you do trend lines, right? And you do that 3 touch. I don't know if you guys know about the 3 touch on the trend line. You know that first, second, third touch. Let me try to zoom out. Let me see if I can get a 3 touch for you to explain more better. So 3 touch is something like this. Price touch 1, 2. By the third touch, you go in. Yeah. So first touch, second touch. We call it second touch anyway, but I like to call it third. So 1 is my first baseline. Price came back to retest. This is my second. By the third one, I want to go in. If you're doing trend line trading, you know, you go in third. And that's exactly the same thing that happened right here on this EMA line. It does the same thing. Price came on the first touch right here. This is your first touch, your second touch, left, your third touch, you can go in. Simple. You go in, then you put your stop loss there somewhere below, based on your ATR value, whatever ATR value it gives you. And then when price start moving in your favor and you lock yourself in profit, you just move your profit zone above, right there. And then when price leaves, you're taking your profit. And if price gets to your profit zone, cool. If price doesn't get to your profit zone and it seems to be coming below, once price cross your 20 EMA, close your trade. Just close it, take whatever profit you have. Don't think, oh man, it's gonna go back and let me take this small amount. Nah, scrap that. The market has more money than you. Take the money from the market. You know what I'm saying? Just take it and walk away. Now, I'm gonna touch on something called on wick whenever I do that post stuff. And on wick simply means but before I actually go to that point, does anyone have questions regarding that? Is there any questions regarding the stuff I just spoke about now, about the entry? Entry confirmation seems to be the EMA and also retest of your breakout zone. Wait for the price to break out, then retest. Once it retests the zone, then you go in. Okay, that's practically what it does. Price broke out from here, retest the zone, go in. Price broke out from here. This is the next stop. Retest the zone, go in. Price broke out from here, retest the zone, go in. Price broke out from here, came back here. Look at how long it took to retest the zone, go in. You understand? Until the entire trend is exhausted. You know, so price also broke out from here. Look, this is breakout zone, retest the zone right here, the consolidation region, go. Price broke out. Let me see. It broke out from here. Now it's coming back to retest the zone. If the uptrend is still valid, price is most likely going to bounce from somewhere around here, go up. That's what's going to happen in this scenario. Okay. So when I say on wick, this is what I mean on wick. I want to buy it on the tail, right? So if I say, okay, I know the trend is going to go down. If you look at something that's very common in this market in most cases has a tail. There's a tail here. There's a tail here. There's a small tail, small tail, small, 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 small. In most 90% of the time, you're going to find a tail. Look, right here, you don't have a tail. Right here, you still have a very small tail. Right here, you don't have a tail. But if you look at it, most of the time, price does have a tail. So what I do and say on wick is this. If I say we're selling on this day, for example, don't sell immediately once the candle opens and start going down. No, I will wait for price to pull up against me first. Then I look for a region of support or resistance that I want to go in around that zone and go in from there. That one, what that does is it gives me more room for my ATR so I don't get raided. And 2, it gives me a better entry because once the price start going in my direction, I'm at the tail. So by the time the next candle comes, it might not get to raid me out of the market. So that's basically what on wick means. Always getting on the tail. Tail like that, tail like that, tail like that. And if you don't have a tail this time around, most likely price is going to consolidate. By halftime in the day, you will know. So you can then go in on the main body. But most of the time, you're going to see a tail. No matter how small it is, there's going to be a tail. So if you're going in from the tail, you're much safer than going in from the body. Okay? So that's what that means. Someone asked a question about what do we use regularly between the 2050 and 200 EMA? I use all 3 together. That's the funny thing about it. I use all 3 together. Now, 20 for me is the fast entry EMA. 50 is the medium entry, and 200 is the long-term entry. So what I do is I stay patient. I stay very patient till price, hits whichever EMA that I wanted to hit. So let's say, for example, 20 EMA, for example, right now is when I want to go into the trade and I know that I've missed my ideal entry. So I'll wait for price to retest the 20 and I go in on the 20. You understand? So far, the 20 and the 50 have spaces between them. If they're clocked up together, I'll go in on probably the 50. But if they have massive gap in between them, I go in on the 20. I put my stop loss behind the 50 or the ATR value, whichever one I seem to be the most widest out of the two, basically. So, but 200 is literally the major key for me anyway. 200 literally. Let me try to see if I can get on a small time frame. Price tends to respect this 200 very, very widely. So let me just zoom out a little bit. So if we look at price, when price was down here, price did a crossover to 200, right? Price came back to the 200, played around the 200, never really, really broke out. What he did was raid people out, and price started going back up. It never touched the 200 till here again. And guess what he did? Raid people out beyond the 200, goes again. And most likely it could come down now this time around, raid people out below the 200, and then go in. You understand? So your entry is going to be between the 200 and whatever region of support that you can find around there if you're going long on this trade, and then go in. Okay. But to be quite frank, 200 is the strongest out of all three EMAs. 50 is the medium strongest. But if you've missed the trade and you need to go on the trade and the trade is running away from you, you can go in on the 20. Just something like this. The price moved away, pull back a little bit. You get your entry from that zone, and then you go in rather than waiting for the 50 or the 200. Just get your entry from 20 EMA. You know, price is most likely not going to touch the 200 very soon. So you set your stop loss at your ATR value or behind the 50 EMA, and you go in. Okay, I hope that answers that question. Is there any more questions regarding to something you don't know? Please feel free to ask, because we still have about 6 minutes left or 5 minutes left. So if you have any questions pertaining to something you do not understand, it's best you ask now, so that way I can get it all sorted for you and speak to you about it.
Please, please, can you hear me?
Yes, I can hear you loud and clear.
Please, can you just go over the week thing again? How do you enter on the week or something?
Okay. So Wick, let me put it this way. Every single candle, right, has a tail. Every single candle has a tail, you know. And what we do is, let me point this out. There's something we used to do in the past. I stopped doing it for a lot of people. Let me see if I have that indicator. What that indicator shows, let me see. Um, I'm trying to get the indicator. It's called a daily average, but I can't find it right now. Probably you have it tucked in somewhere. And what it does is this, right? We calculate, there's a strategy based on weeks only. It calculates the previous week. Let's say, for example, we wanted to do a buy in this trade. We are on this day and we want to do a buy. What we'll do is we'll calculate the wick size of the last 5 buy candles. So this candle to this candle is 7 pips. This candle to this candle is 3 pips. This candle to this candle is 9 pips. This one to this one is 5 pips. And this one to this one is about 3 pips. So we add that previous buy 5 candles together to determine what the average wick size of this candle is going to be. And whatever average that it gives us, I wouldn't look at the market unless price pulls down to that level for me before I then decide to go into that trade. So that saves me from the stress of looking at my support and resistance and my EMA. And I just wait for the price to pull back a little bit between that region to go in. So the old guys that have been here have seen me do this a lot of the time. I've done this before. I just don't do it anymore because it's quite time consuming and you have to do a little bit of calculation with it. But ideally, what you want to do is, if I say, for example, we are selling today, you don't sell immediately on when it's on that day. You wait for price to go up against you a little bit and then go in to the sell side. So let's say, for example, in this day, let's say we're selling on this day, for example, what I'll have said is sell on wick, right? So you do this on your previous 5 candles on the daily time frame. You calculate from here to here. Well, right here about 24 pips. You add your 24 to 13 pips, then to 13 pips again to 20 pips, then to 35 pips, right? You add all those figures together, you then divide it by 5 because they're 5 candles you added, and then whatever that gives you, you plot it right here. Let's say that gives you like 20 pips or 18 pips, for example. I won't look to start going into the market until price hits about 18 pips. So I can set an alert at this level. So I don't need to watch my chart at all. And what I'll do is I'll set an alert at that level, and then from that level, what I would do is I then once it rings like ding, it does that ringing bell stuff. Once it gives you that bell, that's when you look at your chart and then look to start going in. Does that make more sense?
Mm-hmm.
So you wait till the price literally goes to that level first, and then you start looking for your entry. Then you start looking for your using your indication, your indicators if you have one, or you start looking into your support and resistance zone around that region to then go down. So that's basically what that on wick means. I only have 2 minutes left, so I can only answer one more question.
Thanks.
So another body. Yes, the wick is the key. Don't go in on the body. The body, when you go in on the body, you have more exposure. So you can go in on the body, for example, when price is pulling down and price does the stuff and he pulls all the way back up, kicks you out, and then goes all the way back down. But if I'm on the wick, even if price pulls all the way back up, it's most likely going to consolidate at a region that it's not going to be able to go beyond, because the average wick size of the previous 5 candles is already telling you the price doesn't really go beyond that level. So the possibility of that happening again is very high. So you wait till price gets to that region, start consolidating around the region you want to go in, get your entry indicator pointing you to the direction you want to go, then go in. So that way, even if price pulls back, you don't get rated out. Okay? But always remember, lock yourself in profit. It's always good to come out with a little bit of profit than to coming out with loss at every single time. The market has more money than you. So you always want to come out in money, regardless, even if it's £1, £10, £20, £200. Just come out with that small amount of money, £2,000, whatever you want to come out with. Come out with that, and then you can then try to look for a re-entry. Okay, and that practically sums it for today's webinar, guys. We don't have much time. We have like a few seconds left. So if you have more questions, though, please pop it into the chat room. I'll be able to answer a few of them for you. Or if you need help, I'll just message you. Tell me to message you, and I'll message you or get someone to message you directly on the chat room. Okay. Thank you very much, guys.
No trade this week.
And
No trade this week.
I will check trades later. Okay.
Okay, no problem.
Prayers can affect it, but it doesn't really count. All right, guys, take care of yourself,
Okay.
and we'll speak later. All right.